There's a bad recession coming and you need to know about it. Now, the topic that I'm going to talk about today is a little bit more complex than the typical topics I cover in my podcast. But this is extremely important for you to know, and this is really only something that you need to concern yourself with every 10 years. It's called the Treasury yield curve inversion. Now, we're going to talk a little bit about the economy. We're going to talk a little bit about the Federal Reserve interest rate. We're going to talk a little bit about the stock market. But the big point here is that we're going to help you understand that there is a huge recession coming and you need to be prepared for it. I'm going to give you a few things that you need to do to prep. And then what's going to happen is you're going to come out the other side of this thing extremely wealthy. And you're going to be very happy you listened to what I had to share today, because this is what all of the wealthy people in America do as recessions approach. They take their profits out of the market and they let the lower classes crash and take all the losses. So there are some big bad things coming for this economy, and all of the intelligent investors already know it's in the works. So you're asking yourself, why? Why does a crash have to happen? Why is there a recession anyway? What if the economy just keeps getting better? We like our current government. They're making good decisions, and the economy is better now than it has ever been. So let's take the stock market and put it to the side for a moment and just talk about the economy. The stock market has been a little bit of a roller coaster since September. It dropped down pretty low in December, and there was a nice rally after the new year. But what I want to focus on is the current government made some big changes to the way the economy is functioning. And believe it or not, these changes really helped the economy hit the gas pedal and go. And what I mean is the current tax bill and government spending caused tax cuts for corporation, tax cuts for individual families and individuals with their income tax being lowered, and then massive increases in government spending. Those three variables, lower taxes for companies, corporations, lower taxes for individuals, and higher government spending, means that the economy is on hyperdrive. Now, right now, the economy is like a locomotive flying down the tracks full speed, and unemployment is at like all-time lows. So how could this be bad? The problem is our economy isn't a train that goes down a track one way forever. Our economy is actually a pendulum that swings back and forth. And this is no secret. This is just the way the economy works since the beginning of time. It's called a business cycle or an economic cycle. And the typical business or economic cycle lasts 7 years, maybe on the high side, 10 years. Now, again, there are no secrets here. This is taught in every business class or every business school around the world, but especially in the United States, because we're talking about the United States economy. But many countries have an independent Federal Reserve Bank, just like the United States. And our Federal Reserve is chartered to have keep the U.S. inflation at 2% and keep it there. Now, when we have an economy like we have right now, it's just pumping on all cylinders, and it's going. The problem with that is that can lead to inflation. That can lead to jobs, higher pay. It can lead to products costing more. It can drive up home prices, and anything from a bottle of ketchup to a vehicle, things get more expensive. That's called inflation. And what the Federal Reserve and our current Federal Reserve Chairman, Jerome Powell, that was appointed by Donald Trump, it's Jerome Powell's duty to, along with the other Federal Reserve officers, to keep inflation at 2%. So how did they do that? They do that by raising the interest rate. So what I want to talk about for a moment is when you raise the interest rate, that reduces the ability for banks to lend money because interest rates go up, lending costs more. So think about it. If your mortgage interest rate went from 3% to 10%, it's an exaggeration. People aren't going to be taking a lot of mortgages out, right? Because it's going to be costing too much for interest on a mortgage loan. Same with car loans or student loans or any type of bank loan, mortgage or other, or credit card interest rates. All of these interest rates go up when the Federal Reserve interest rate goes up. So lending dries up. Therefore, the economic cycle starts to slow down. Now, where are we? Why are we talking about this? What does this have to do with the recession that's coming? There's something called the yield curve, and it has to do with the U.S. government, Treasury bonds, bills, and how we measure the U.S. economy. So just to go through the basics here, a long-term Treasury bond might last for 30 years. Say you give the government $1,000 and they hold on to it for 30 years and they give you a nice interest rate. Let's just make it up and say it's 5%. Wow, that was a good return for my money. And the government rewards you for saving for so long. Now, if you were to give that same $1,000 to the government for 1 year, they're not going to give you 5%. They're going to give you a much lower interest rate, maybe 1%. So these are just made up ballpark numbers. So the idea is the long-term Treasury bond yield is a lot better than the short-term Treasury bill yield. So that's the natural order of Treasury yields. The longer the Treasury note or bond, the better the interest rate. The shorter the bill, the worse the interest rate. So now we talked about this concept of when the economy is on overload like it is right now. The economy is great. Everyone's got jobs. Everyone's spending money. But when the interest rate goes up by the Federal Reserve to prevent inflation, what's going to happen is the interest rates on some of these treasuries are going to change as well. And so when the short-term treasury bill, the 2-year bill, starts to go up, then something can happen called a treasury yield curve inversion. And this is really bad. This is what precedes every recession since the Great Depression back in the 1930s. And this is what's about to happen. How do we know that? We know that because the 30 and the 10-year bonds interest rate has been dropping and the 2-year bond has been climbing. Not only that, but the 5-year note and the 2-year treasury bill have already inverted. And that happens before the 2 and the 10-year invert as well. And so when the 2 and the 10-year treasuries invert, get ready for financial Armageddon. And that's what happened in 2008 in the housing crisis, and that's what happened in the dot-com bubble, and that's what happened in the 80s and the 70s and the 40s, back in the 1930s. You can isolate, root causes of each recession for on a particular subject or a particular meaning, dot-com businesses or predatory lending in 2008, which led up to that. But the thing is, it's the treasury yield curves which indicate where the economy is And right now, we're headed for a crash. So what? How do we prepare for this? How do we prevent losing our life savings, our retirement, our home, losing our job, and having to sell everything at the bottom for bottom dollar just to make payments so you don't lose your car and your home? Right now, save cash, stockpile cash, save as much as you can. I personally think we have about between 12 and 36 months more until we see the yield curve invert. I think for the short term, we're going to continue seeing a huge spike in the economy. But, when the chickens come to roost, we're going to have to raise the Federal Reserve interest rate. So sell your stocks now. That's what I did back in September. I sold a vast majority of all my assets that I had in the stock market, including my retirement. Wait a second, your retirement. I shifted my retirement investment portfolio into stable money market accounts that were invested in either cash or short-term Treasury bills. And I'll get to that in a moment. Sell your depreciating assets now, because those are going to be worthless when the economy crashes. Please don't buy anything new right now. Don't buy a new house. Don't buy a new car. Don't buy a new snowmobile. Don't buy a depreciating asset, and especially don't buy a home, an appreciating asset like a home. Don't buy an appreciating asset right now, because as the pendulum swings up, the further it goes up, the harder it's going to swing the other way. So you might think the home you're buying right now it's worth $800,000. It's going to be worth 1.2 in just a couple of years. You're buying at the height of the cycle, and we're going to go through a couple of years, as many as 5 years, 6 years before we're back where we are today. So if you buy now, you're going to be underwater on your mortgage or your loans for 5-6 years just to get to your present value. So you're stockpiling cash. You're not buying anything. You're not buying a house. And please don't buy gold. Gold is just a commodity. It's like buying a bushel of potatoes or buying a bag of rice. It's just a commodity. Go buy a copper. Gold is a bad investment. It is highly cyclical. It is highly volatile, especially in down markets. So wait for the economy to crash. We'll know we're getting close when the VIX, which is the fear index, peaks over 40. It's a fever pitch then. Wait till the Treasury yield curve between the 2 and the 10-year note inverts. When the Treasury yield curve inverts between the 2 and the 10-year, the 2 and the 5-year already inverted. Once the 2 and the 10-year, everything's going down. I personally would wait 24 months after the economy has dipped and after the inversion happens for the dust to settle. You don't know how far down the bottom is. And if you're trying to, buy exactly at the bottom and time the market, you're going to get burned. Just wait till the dust settles, when everyone has lost everything, when they're foreclosing on their homes, when the stock market is barren. And at that point, you're going to be so thankful that you planned ahead starting today, and you started saving up as much cash as you could, because in 3 years from now or so, when everything has been decimated, maybe even sooner, you're going to be in a position to buy. There are going to be buying opportunities everywhere. If you don't do what I said, you'll be devastated. You'll ride all your investments down to the bottom. You'll ride your home mortgage down to the bottom. You'll take all the value of your assets down to the bottom. No one will be buying anything because no one will have liquidity. If you do what I said, you'll have liquidity. Liquidity is so important. Ask Warren Buffett. When there is a market where there's buying opportunities, you want to have cash. And that's where we're headed. That's why I have so much cash. And that's why when this economic cycle comes through, I am going to come out the other side so much more wealthier. Ask Dave Ramsey, ask Warren Buffett, ask any investment manager, and they'll tell you the same thing. So start prepping now. I mentioned that, in my opinion, the only safe investment is cash and short-term treasury bills. You're probably saying to yourself, but cash, that's a depreciating asset too, because with inflation, cash loses about 2% value a year. Yes, I know that, but it's a safe place to park your money. You could also invest it in a short-term treasury bill if you feel that much confidence, and you do your research. You could invest it into a money market account that invests in short-term treasury bills, or directly into short-term treasury bills. And they have, it could be a 0% interest rate, it could be a 1 or 2% interest rate, but basically the idea is you're not making money off your cash right now. You're saving it for when everything drops 20, 30, 40, 60%. Everything's going to drop so low that the value of your money now, even though it's not appreciating, is going to be worth so much more at the bottom of the market. So you can thank me in 8 years when you've gone through this process. You've saved your money, you bought when there's great buying opportunities, and your investments yield 500% return, 5x on what you bought. So this is why we pay attention to the U.S. Treasury yield curve inverting. Thank you.